guys, welcome back, and we're going to talk about the stock market today because it has been all out of whack in the month of March, and I want to discuss about how it's important to stop trying to time the market and start putting time into the market. So let's get into it. So if I have $5,000 and I place it into the market and I don't touch it at all, I don't add to it, I just take that $5,000, put it into the market, and 20 years later, if I have an average of 7.5% annual return, I should have over $19,000 in my account. So what the crazy part is that if you literally just miss 10 top days, 10 top performing days over that 20 years, you literally cut your annual return in almost half. So now you're at 3.4%, and then you see here how drastically your return goes down. You lose over $8,000 because you got nervous at one point and you took your money out and you stayed on the sideline a little too long. So when it hit that top performing day, once you got back in, it was a little too late to make up that $8,000. And if you continue on to the chart, you would see that you would lose even more of your return if you miss out on the top 20 days, and that's literally not even 1% return that you're getting. So you're just hitting pretty much even, just making a couple dollars more than what you originally invested in that 20 years ago. Imagine having $5,000 and putting into the market, and then you keep taking it out, putting it back in, taking it out, putting it back in, trying to time the market, and then you end up with only a couple dollars more 20 years later. So here's where it gets a little crazy if you miss the top 30 days. So let's say you take your money out and you put it back in, and then you miss another top day. You take your money out in year 4, put it back in, miss another top day. You do this 30 times, and all of a sudden you have a negative return, which is so wild to me, and which is why I literally just like to just keep my money in and stop trying to time the market, because I feel like I will never win. But yes, you see here you miss out on over $16,000 in value of what you could have gotten if you would just let it sit into the market. That's $16,000 just because you weren't patient enough, or you just wanted, or you just feared the market. So now that we have an understanding on why it's so important to stop trying to time the market and just stay in there and stick it out if you're a long-term investor, let me make that really clear that this advice is literally for long-term investors only, because if you have short-term goals, you may want to get out sooner if you're trying to make quick money and within 3 or 4 months or things like that. This is for my long-term investors, 5, 10, 15 years out. We're not looking to touch that money at all. So just keep that in mind. With us staying in the market and not trying to time the market, it's very important to understand the average cost basis so you can get a better bang for your buck, pretty much. So for instance, let's just say we have this healthcare stock. So this healthcare stock, we buy 100 shares at $50. So that is a $5,000 investment we just put into this stock. And then all of a sudden, let's say 3-4 months later, the stock drops. The stock drops down all the way to $30. And instead of panicking and selling and losing some of your initial investment, let's just buy more. So we end up buying 50 more shares at $30 per share because we want to offset our costs a little bit. And so that will give us an additional $1,500 invested into that stock. And once we get the combined initial $5,000 investment and that $1,500 investment, now we have our cost at only $43.33 per share versus the original $50 per share. So that's a 13% discount, which that's how average cost basis works. So when the stock drops and you believe in that stock, I would do this if you really believe in the stock. If you really think it's going to go back up and they just had a slump and you read over like the financials and you understand everything, definitely buy the stock when it drops. I've done it. I've been doing it a lot since this whole market started coming down a little bit. I've been buying low, buying low, buying low, because eventually I trust that my stocks that I've invested in are going to go back up. And then once it reaches that $50 again, in this instance for the healthcare stock, you will make a better return. You always want to have a creative way in making money because you don't want to always depend on just the market. And if you're leaving the money in the market and you're not touching it, pulling it in and out, then find creative ways to make money outside of it. So for instance, in my case, as I explained to you guys before, I've resold sneakers in the past. And usually it's just 1 or 2 a month, but this month I've sold a lot more, and I've been using that money. I would pretty much quick flip it, make 40% return on that sneaker, and then I'll put that money, the profits, into the market. I hope these tips help you with being more comfortable with staying in the market and to realize it's a long-term game and to understand that you're not going to lose money if you just stick it out. You usually lose money when you panic and sell and then you just take the loss because you didn't want to ride out and think you're going to lose more. As long as you trust in the companies that you're investing in, as long as you trust yourself, just stay in the market, stick it out, and just let it be. Sometimes I don't even open my app. If I know it's a really red day, I'll just probably buy some and then close my app. Just buy it and close it, walk away. And please don't forget to like, share, comment, and subscribe below. And I have more content coming for you soon. And until next time, bye.